Howdy, Jacob here. Today we're looking at the Cooper companies in the healthcare equipment and supplies industry. 18.5 billion market cap on 21 billion enterprise value. They develop, manufacture, and market contact lenses. Damn, that market as big as this? I did not realize that market was well over 18.5 billion, but I guess, yeah, okay, I guess that makes sense. Founded in 1958, so they've definitely been around for a while. Their growth is very impressive, though. We are seeing over double. That's not true. It is true. 3.4. Yeah. So over double revenue in the last 10 years, which is about a 6 to 8% compound annual growth rate on revenue. Gross margin higher than it was 10 years ago. Operating margin down slightly, but still 15 to 18% is not bad for an operating margin. Good earnings per share. Pay a dividend of 2 cents. I don't know why you pay a dividend of 2 cents. That's just dumb to me. Whatever. That's like Nvidia's dividend. I mean, I don't know why. Just why. Whatever. Return on invested capital, pretty poor, mid-single digits. Nothing to brag about at all. Their balance sheet shows 121 million cash and equivalents with 44 million short-term debt, 2.5 billion long-term debt. Lot of net debt. Looks like they made an acquisition here of about $1 billion. Funded it through debt. Love that. Not all right. Cash flow. Boom. 1.6 billion acquisition. 1.2 billion in debt. Yay. Fund acquisitions through debt is what I love. Absolutely not. I'm totally kidding. So their debt has gone up from 302 million in 2013 to 2.5 billion in 2023. So again, leverage growth looks fantastic. Great. Your revenue's growing 8% a year. It's fantastic. But there's going to be a time where the debt's going to be coming due and you're going to have to repay it or refinance it. And you're going to have to pay that due. And it's going to affect your future growth because it's going to have to take your capital allocation from now to go towards debt reduction. And yeah, you would have grown slower in the past, but then you'd be able to spend more money and time on future capital allocation for growth and efficiency, which they're not going to be able to because they're going to have to focus on debt reduction. Either way, 2.5 billion, what do we say? 2.5 billion in long-term debt. Their 5-year free cash flow is kind of all over the place. Let's say 400 million. So 400 million is going to be about 5.5, just under 6, or I guess over 6. So 6 to 7 years of their 5-year average free cash flow to pay off that long-term debt. That's a lot of debt. That's a good amount of debt, not in a good way. That's a good amount of debt, as in it's a lot of debt. Their use of free cash flow has been very heavy on the acquisition side, a little bit of share repurchases, a dividend that pays out literally nothing, just get rid of it. It's stupid. Their debt, they've just been going into debt to fund these acquisitions. So my future revenue growth and all of these assumptions are going to take into account whatever, 20 to 40% of their capital allocation going towards debt reduction, not over 100% to acquisitions, just to leverage yourself and not be able to longevity, keep doing it forever. And so this is going to be assuming 20 to 40% of capital allocation going towards debt reduction, maybe 10 to 20% to share repurchases, and the remaining, whatever that is, 40% or so to acquisitions. And with that, I think we can get 6% still in revenue. I think margins can be, let's say, 12 and 14. It's kind of all over the place in margins. Share repurchases, I mean, let's just say they offset stock-based compensation. That's less. That's 15% of capital allocation. I'm fine with that. Terminal PE on a 5% growth, but also enterprise value a bit higher in market cap. Maybe 15% return to look for. And we're saying it's stupendously over the price I'm looking for. It's going to have to fall 5 times. Yeah, it's not looking like the most attractive company based on price. And honestly, based on the business and what I'm seeing in the numbers, it's also not looking attractive. So not the best company. in my perspective, especially from an investment standpoint. But either way, I hope you enjoy the video, and I hope you have a great rest of your day. Thank you.